Hi, everyone. My name is Dan Weiskopf. I'm the ETF professor, lead ETF strategist for the ETF think tank. And today we're really fortunate to have Michael Kantrowitz on our happy hour. And we'll get right into it. We're going to let some people join us momentarily. And David, maybe you can start off and tell us about yourself too, and then tee Michael up.
Sounds great. Hello, everyone. David Chikinsky here, fellow portfolio manager within the Title Financial Group. We were talking pre-show. There's just so much going on in the economic backdrop right now, so it's going to be really interesting. This is an area that Michael knows a whole lot of. So without further ado, Michael, I'll kick it off to you. If you could introduce yourself and tell us a little bit about your background and how you got to where you are today. And then you can tell us how to solve today's market problems.
Sure. Thanks for having me on, everyone. And hello, everyone who's joining. So I'm Michael Kantrowitz. I am the chief investment strategist at Piper Sandler. It's a public company. Prior to that, I was the chief portfolio strategist at a firm, boutique macro research firm called Cornerstone Macro, for about a decade, 2013 to 2020, end of 2022. Before that, worked at a place called Wolf Research. Before that, ISI. And I started my career at Merrill Lynch a little over 20 years ago with actually a technology background. My first job was I was a programmer. And I wanted to do something in the realm of Wall Street, but use my programming skills. And then I realized when they placed me out in Hopewell, New Jersey, I was in the middle of nowhere and not where I wanted to be. So anyway, 20 years plus later, I'm kind of where I think I should be. So we'll leave it there.
And give us a little brief overview of your outlook, okay? Or are you optimistic, pessimistic, or quote, constructive, which quite honestly never really means a whole lot to me, but...
Yeah. I guess I'm more selective, but yeah. So I had a bearish view last year that was definitely wrong. I was in the pool of folks calling for a recession, and around early October of 23, I kind of I hate to use the word pivoted, but really kind of put aside my framework, because what we were seeing going on in markets in October, remember the markets were selling off starting in August, September, October. And it was all about one thing. It was all about higher bond yields, and people started tripping over themselves, trying to say how high yields were going to go, how much the Fed was going to hike, which was basically the same thing we had seen the prior year with regards to CPI, when CPI in October 2022 was just rolling off of 9%. So I kind of looked back and said, all right, sure, there may be a recession or maybe they're not, soft versus hard landing, let's put that aside right now because the market's focused on one thing and people are freaking out over bond yields. And given our outlook that we still expect general growth and earnings to continue moderating, I don't really see this massive sustained move up in bond yields. So I wouldn't say we kind of pounded the table turning bullish, but we basically made it a one variable function saying if bond yields start coming down, if we get some soft employment data, soft PMI data, better CPI data, and maybe a dovish Fed, and we got all of that in November and December, the markets are going to scream higher, regardless of anything else. And we've seen that, I've seen that time and time again in my career. When you can identify that there's something taking down the market, like think of oil in 2015 into early 16, that's all that matters in that time frame. And so when bond yields started coming down, what we were focused investors on is looking for stocks that have positive correlations to bond yields. Trying not to recommend, buying low quality or so-called junk, but really try to focus on our more intermediate term view that earnings growth's not picking up anytime soon, and that you want exposure to bond yields. So that, create a lot of interest rate sensitive stocks that showed up in those types of screens. And so as we came into the year, in our outlook this year, we kind of laid out and said, okay, the market's priced in a soft landing or pricing in a soft landing, which is, a ton of rate cuts. I think at the beginning of the year, we had 7 rate cuts priced in for this year. The PE was back to the highs of the last 2 years. Credit spreads were at 2-year lows. Sentiment was through the roof. The market was at an all-time high. I mean, that's what a soft landing being priced in looks like historically. And so in our outlook, we kind of said, all right, there's probably not a lot of upside this year for the broader indices because we've kind of priced out a lot of the problems of the prior 2 years, i.e. inflation and the Fed. We don't think they're going to come back as problems. That's not to say there won't be volatility. Heck, there's been a lot of volatility this week. But we think yields have peaked. We think the Fed is done. I think the Fed being done was verbatim confirmed by Powell yesterday. And unless we see stark jobs deterioration, the market's going to have a floor underneath it. And what's going to do well is not the same low quality beta deep value junk that worked in November and December, which made sense, but it's going to be stocks that basically have better earnings outlooks, better balance sheets. So we're kind of back in the quality camp, and that was really our theme. The irony last year is we had a bearish market call, but had a really good positioning call, which was profitable growth stocks last year, and that was because of our longer view that earnings growth will continue to grind lower, expectations will continue to grind lower, and perhaps we'll have a recession. So what we're recommending right now is still a lot of that. We added a free cash flow yield or valuation component to that because in backdrops where valuations kind of get stuck with a ceiling, investors typically pay more attention or more valuation discerning. So I think that makes sense this year. So we put out a range for equities, assuming a soft landing. Not that that's the assumption, but that's what I want to communicate. That the market will always assume it's a soft landing until we get a negative payroll print or claims, spike higher. And so that's my kind of current outlook right now. I think markets will range between +5 and -10 in that macro outlook. Obviously, if we see sharp deterioration in employment, it's a problem. But something Powell said yesterday really caught my ear, which is if employment deteriorates, he's going to cut rates quicker. So to me, that gives you somewhat of a longer bridge, perhaps, where equities, not all equities, but maybe some of the higher quality equities can remain somewhat bid or certainly relatively bid if we see weaker employment data before, and if we eventually do get to a contraction and really ugly employment data, which we don't have today.
So many amazing things to rip on here. And first off, I want to congratulate you as like the first economist ever to lead off with like, this is what I was wrong about last year and how my opinion and viewpoint changed on that. I think that's so refreshing. I think one of the most interesting moments about that reversal in yields was the retail flow, right? TLT had massive inflows. It's actually something that people don't talk about. It's a trade that retail got right in spades. But you also later mentioned correlations between stocks and yields and looking for stocks that might be uncorrelated to the rest of your fixed income portfolio, which that moment in time also was the exact moment when stocks and bonds just got like significantly correlated basically until today. Even today, right? Stocks are up big, duration was up huge. So where do you find these pockets? What sectors are actually adding some diversification there? Like, how do you look at it from that perspective?
Well, let me make sure. Maybe I misspoke, but we were looking for stocks that were correlated to bonds. Right. Because majority of my clients are equity investors. So as a way to play macro, I guess there's a number of ways you can play that. Obviously, if you bought banks in November, that was a one way to do it. You could have bought low quality, really leveraged companies because if interest rates come down without a fear of recession, credit spreads will typically tighten and you get a huge bid in low quality stocks. So that's another way you could have kind of played that. We just looked for stocks that were positively correlated to bond prices. Maybe that's the way I should have said it. And so, it came up with a lot of interest rate sensitive groups like home builders and a lot of kind of growthier companies as well. And so, we had a list of stocks that we considered high quality, but also positively correlated with the bond trade. And those more than beat the market. They didn't quite keep up the Russell, but I think, you had to own a lot of low quality stuff to really beat those indices. So at the beginning of the year, we kind of took a breather from that because, I kind of thought the market had gotten a bit ahead of itself with 7 rate cuts priced in. I don't think we're going to see, nor have we ever seen 7 rate cuts unless you've seen unemployment really crack. So, I think the market's taking a breather there, though obviously we've seen yields come in today pretty sharply lower. And perhaps, we digested it. But I think the yields are going to be very data dependent. If we get a hot jobs number tomorrow, and there's some reason to believe that the data may be a little stronger from the seasonal issues, you're going to see yields back up. We're in a very data dependent market here. And so the way I kind of see it, to answer your question, there's 2 ways you can play this. You either have to kind of be a market timer or a data timer and say, okay, is this data going to come out dovish or hawkish? And is that bullish or bearish, which is very event driven and kind of rolling the dice a little bit? Or, again, for my clients that are institutional investors, they can't day trade like that, nor is it their mandate to do so. Try to kind of have some exposure to a view on yields, but at the same time, stick with their mandate and, looking for quality stocks, companies they think that can appreciate. So I guess, those are the various ways to do it. I think the explicit way to do it is just correlation, math. Because if you dive, if you're just going to buy home builders or just buy banks, that's not a very diversified way to do it. I would kind of take an approach looking in each sector, which stocks kind of come up on that screen and pull those together, because then you're more playing bonds than you are playing an idiosyncratic sector. Again, like today, bond yields are down a lot. What did we end the 10-year at this afternoon? 380 something. And look at regional banks. They got crushed today because of fundamentals. So that's actually a case in point right there.
To talk to us further about banks and financials in general, because I think that's going to be the critical sector, and it lines up very well with some of what you're saying, meaning quality, dividend, correlations with interest rates. The thing that I'm challenged by, though, is I don't think about banks necessarily in the same vein as quality. Some are quality, but their balance sheets are suspect in my mind.
Yeah, well, I would say there's some banks that I wouldn't call banks quality. I wouldn't call any sector quality. I tend to think of that only at a stock level. I would call banks. Yeah. There are certainly higher quality and lower quality banks. I guess my point was just that they were the bond trade basically for the last year, essentially. And they still are to somewhat, but, one of the themes I've had this year is that, we're going to see pockets of strength in the market where we're not in earnings season, or we're more likely to see it when we're not in earnings season, because I think even weak macro data will be welcomed, especially softer employment data will be welcomed by the market to an extent. Same thing as lower CPI. That's all good news. We're nowhere near deflation risks. However, where I think we're going to see more downside and single stock problems is when we have earnings season, because if you think about it, CPI coming down, that's great news from a macro perspective. But if you're a company, that means you have less pricing power. And if you've relied on pricing power to grow your revenues, that means that you're struggling more. And obviously soft macro data is usually consistent with soft demand data. And so even though it would be welcomed by the markets because they're worried about the Fed, when a company reports earnings data and they're weak, reflecting the last quarter's soft data and lower inflation, reality sets in and those stocks get punished. So I think we're going to see a lot of that during earnings season, or in short, markets from a macro perspective may still celebrate soft macro news and soft inflation data. But at the single stock basis, bad news is bad news and good news is good news.
Yeah, I mean, earnings growth is still pretty high for this year and next, and we end in this kind of perpetual cycle of like, we're going to have double-digit earnings growth, and then it just comes down and it's like, whatever, like a 7%, and everyone just kind of accepts it. Is that like the reality of what we're seeing again in 2024?
Yeah, well, we started the year, I think we're still roughly, the consensus of the street is still expecting about 11.5% this year and roughly that next year for the S&P 500 again. And that's, it's becoming silly to talk about the S&P 500 even from an earnings perspective, because it is really largely 7 stocks driving that. If you cut out the Mag 7, I think that number goes down to about 8%. And so that's a decent amount lower. It's not dramatically lower. But again, the breadth of the earnings data doesn't really reflect the index overall. In an average year, earnings estimates data going back to 85 from the start of the year, and everyone always starts out the year optimistic, and then has to usually gets less optimistic. The only times where that doesn't happen is really coming out of a recession, where people usually start off pessimistic. But on an average year, those estimates generally fall by about 5 to 6%. And so that's an average year. For whatever that's worth, that's average. Maybe this year is a little weaker because of some of these lagged effects of high rates, and Fed's probably not going to cut 7 times. But again, going back to my market outlook, we started the year with really no risk priced in and high earnings expectations. That's not where you get the beginning of a 20% surge in equities. One big difference between the start of 2024 and the start of 2023 is that in the prior year, in 22, stocks were down 25%, whereas last year the index, was up over 20. So the starting points are very different. The valuations are very different. The risks priced in are very different. And that's why I don't think there's a lot of upside for the index, but I think investors are going to continue to narrowly focus on companies where they do have better earnings momentum and visibility. And something I don't expect this year is a real broadening improvement in earnings expectations, which I think is historically necessary to get a broad market rally that is sustainable. If we look at small caps, they've ripped off the November lows, but they've done that like 4 or 5 times in the last 2 years, and they can't get above 2,000 on the Russell or 200 on the IWM. And I think if you look back at the movement of all those moves, they're all macro driven. They're all PE driven. They're all fear on the downside. Rates are going to go higher. The Fed's going to cut more. We're going to go into recession. And then they're all hope and euphoria on the upside. The Fed's done. Inflation's done. No recession. But the reason I think they've been stuck in this range and may continue to be stuck in this range is because their earnings estimates as a group have basically gone sideways for 2 years. And I don't see an imminent turnaround, at least in the first half of this year.
Got it. And this year you have said you like, free cash flow stocks. You mentioned the correlation between growth stocks or other areas of the market and the treasury markets. That trade feels over, right? So how do you unwind that trade now? Is it outside of the free cash flow stocks? Like, what else is there in the market? And are you taking into account like the shorter term movements? It sounds like you're expecting a pretty decent year in the equity markets, but there's many different paths to like a 10 to 15% return in equities. It's not often a straight line. So what do you do here now today, a month into the year? Qs are going to open up tomorrow, up like 6, 7, 8% on the year already. Free cash flow, what else is there of value where there's further breadth in the earnings besides for these 7 stocks?
Yeah. So I guess the recipe for what we recommended for the last 2 years has been leading into companies that have higher profitability, higher realized earnings growth. And there's a big difference between realized earnings growth and hopeful, pretend, future estimated earnings growth. In addition to that, layering on companies that have positive earnings revisions. So put that all together. Again, it's not any of those individually, but the combination or the culmination of multiple layers. And to me, that's what quality is. And I think, the biggest risk to that type of portfolio, which has done well in the last 2 years, those traits, the Mag 7 are like an example of those, obviously the poster children of them, not all of them. But if you look at the top 50 stocks last year, the weakest of the top 50 was still up 35%. So like you actually could have owned the other 43 stocks and still had a really good year, beat the market. And what they all had in common, these 50 stocks, were they fit into at least one of those buckets I just mentioned of earnings growth, profitability, and other quality metrics like high interest coverage. So, those are the types of factors we're looking at. And that's really not because, we necessarily are pounding the table on a recession still. I still think it's a risk. But flip it around, I just don't see earnings broadly getting better right now anytime soon. And if you look at earnings estimates for large cap, mid cap, small cap, and literally every sector except large cap tech, they've been going down for the last 9-12 months. Just thinking back, before then, I don't know if everything was going down, but there's no sector of the market where 2024 earnings estimates are rising besides large cap tech. So that's, 11 sectors times 3 size buckets, right? 33 different groups. And there's only one area. So the NASDAQ's up a lot because NVIDIA's up a lot, and a couple other of those stocks are up a lot.
And yet, and to your point, large cap tech is like 30% of the S&P 500. So it really, really does matter. And further to your point, I think we just had Apple report, and I'm not asking you to speak about Apple, although quite honestly, Apple arguably is an asset class in itself. Depending on how that single stock does in terms of earnings will impact, how the equation works. But here's the question I wanted to ask you. I just wanted to take a step back. You use the word hope frequently. Let's take a step back because that's an important acronym for you and how it breaks down your thinking.
Yeah. So HOPE stands for, it's a sequence that I created about 2024, 6-7 years ago. It stands for housing, orders, profits, employment. It's, I post some of this on Twitter and people keep saying, oh, look, hope is broken because we haven't got a recession. That doesn't mean it's broken. It just means we're not having a recession if you don't see E contract or the employment contract. And so, the question is if on employment, so is housing, orders, profits, employment, that's what HOPE stands for. Is the housing data getting better? Are the orders data from all the regional PMIs, the ISM today was better? Are profit estimates going higher? And then, looking at the employment trends. So people have been asking me, what part of the cycle we're in, and it's not exactly that clear, or it's not how I think about it. That, we're in one part of the phase of the cycle, because there's only kind of two periods where they all correlate. When you're coming out of a recession and when you're going into recession, they all go up, they all go down. The Fed's done, and every time the Fed has stopped hiking, whether recession was coming or not, housing data bounced. That's happening now, and I expect that. That's certainly just reflecting lower interest rates. PMIs, the regional PMIs in the U.S. were pretty horrific this month, yet the ISM, new orders, is back into expansion for the first time since the middle of June. So there's, some mixed data there. We're always looking for sustainability. The profits data, again, I would say it's very bifurcated still. There's not many areas of the market where estimates are stable or moving higher. Those stocks that are getting that, are seeing that, are certainly those that have been outperforming, and I think that'll continue. And then employment data has been really mixed. Look, we saw a really weak ADP print this week. The NFIB hiring plans, so that's a employment report from the National Federation of Independent Businesses, so small businesses. Their hiring plans just hit the lowest level, just reported today, since May of 2020. So they're 14% of businesses in their response, a survey response, a monthly response, said they're going to be hiring more. That's the lowest, again, we've seen in 4 years, roughly. We saw the jolts get better this week. You could take whatever data you want this week and point to, bullish or bearish. And that's kind of been, to me, the backdrop. And as long as that's the case, markets will assume soft landing. And so that's why I would say I've wanted to communicate since October a more constructive message, not because my views on recession risks have wildly changed. I think things have evolved. Oil's really low, and that's certainly something that's super bullish and certainly super anti-recession. But we're still seeing data that's not consistent with a soft landing in the employment backdrop, and we're still not seeing earnings revisions be really strongly, broadly improving. So we're in this kind of macro purgatory state here, and we may be here for another 6-9 months. until we can clearly see we've had a soft landing, which is when PMIs go above 50 for more than a month, which hasn't happened yet, or when obviously if unemployment goes higher, which hasn't, has picked up, but it certainly hasn't moved up to any problematic issue. And again, what Powell said to me, we've had 2 years of getting our rear ends kicked around by bond yields. So my bet is that if we see soft employment data, it's bullish for equities. Strong data is going to be bearish for the foreseeable future because of that perceived Powell put. I mean, he literally just said it yesterday.
What about seasonality in the face? Oh, sorry.
I just want one thing though. To me though, that doesn't mean go out and buy everything risk on, because the difference in November or October 31st, or whatever the low and the high in the yields are and the low in the market, people were freaking out about how high yields were going to go. And that sets you up for a really coiled spring. Valuations were, much lower in large cap, small cap. The market, S&P was at 4,100. That's not the case today. So the spring is not coiled. So I don't think we'll see the same junk reaction to lower yields. And, I'd say again, look at the last few weeks. It's not going to be as welcomed.
I'm going to ask two questions. One is on seasonality, and if you guys do anything on reverse engineering some of the stated seasonality numbers, given some of the wackiness that's coming out of this yin-yang in COVID. Is that something you guys spend some time doing, just because I feel like it's so important? And I actually totally lost my second thought, so why don't you just comment on that? The second one, sorry. The second one is QRA. Can you give us some thoughts into what you guys looked at from a macroeconomic perspective on liquidity, tightening and loosening, et cetera, and make sense of this QRA for all of us? And that was also this week, right? In the bevy of all the data that we've seen.
Yeah.
Come out, so.
And that's what I find fascinating. I've been doing this for almost 20 years, not quite, but almost. And really post GFC, I've noticed that, it feels like every 6 months, some new macro narrative comes out that people have never heard about, that's been around for a long time, and everyone becomes an expert. And maybe that's also because of the rise of social media. But it's certainly not something that I really anyone focused on prior to COVID or even the last year or so. I'm going to say it's not really in my wheelhouse. We have a policy team at Piper that focuses on the Fed and that. And, I'd say more broadly, we're concerned about how much rate cuts are priced in that are going to be upset, rather than trying to, game theory out how Yellen's going to finance her next spending spree. First question, seasonality. Also, and I hate to pass the buck, but again, we have an economics team that I work with. Her name's Nancy Lazar. She's one of the top economists in the street for forever. Seasonalities cause a lot of problems in people's models and historical regression analysis, and even the government. I mean, the government would even point out that there's been some weird things. And we saw this post 2009 too. I remember in the years 2009 and 2010, because of the GFC, there was a lot of funky seasonal issues, and then you had these big revisions. And so we're seeing that in the data. We're seeing a lot of revisions. And, I think a lot of, think about claims. That's one example where, there's been a lot of debate on the street whether or not seasonality has made that data less accurate. And therefore, we've seen a lot of economists try to take old seasonal measures from pre-COVID, seasonal adjustment measures, and seasonally adjust claims and point out, look, they would have been a little higher if we not seen that. Again, you can kind of you can make up your own data. Doesn't mean people are going to believe it. So instead of trying to figure out the black box of seasonality that some of these, the government agencies that collect the data use, I kind of feel like it's just better to try to corroborate all the data we see with other data, and therefore, have some more conviction in verifying whether that's a one-off or an outlier, or it makes sense or not. So again, with respect to claims, there's been a lot of mixed data with claims. Claims are still very low, even today at 225 or so. But there's a lot of other employment, again, like the hiring plans I mentioned, or we got the layoff announcements from Challenger, which are back to 80,000. We've seen layoff announcements all week that haven't shown up in that data yet. So claims are definitely, I wouldn't say definitely, but I would say I strongly believe claims are overstating the strength of the labor market. And there's valid and speculative reasons why they're so low. But I don't think the labor market is as strong as what claims are telling us.
So Michael, I think we've been talking a lot about U.S. data, right? But we can't live in a bubble. How do you view the international?
Why not? Investors have since 2009 in U.S. equities.
By the way, touche. Because by the way, I feel like we're grilling you, and I don't mean to be doing that. I apologize.
No.
But what's your view internationally? Because clearly, like what's going on in China, you're talking about data. You could argue that maybe their data isn't, doesn't have the most integrity, but so there's some questions about ours too. I would also argue.
Well,
how do you integrate international information?
Well, so just on that point in China, what we used to do, years ago, I remember like 2007, 2008, and years following, you'd always check China's export growth with their trading partners' import growth to see if the numbers matched up. And oftentimes they did. So again, it goes back to that point about corroborating data. I don't believe any data, it's kind of trust but verify.
Yeah.
Or maybe question but verify.
But your acronym with HOPE, has a requirement for data, right?
Yeah. So, but for each one of those, we look at several different. So for housing, we used to only look at we kind of focus generally on the NHB index, which is a survey of builder sentiment, and that's been around since '85. But then this past 2 years, we saw this dichotomy between existing home sales and new home sales, and this dichotomy within the housing sector. Like if you own home builders, that was a great trade for a while, and still has been a great trade. Whereas if you bought furniture companies and companies that made a lot of the components, durable goods that you buy when you buy a home, which the demand for that stuff went down pretty sharply the last year, you got a very bifurcated backdrop. So the point about COVID you raised earlier, I think has made that even more important to corroborate data and not look at indices, whether it's the S&P 500 explaining really what's going on underneath the surface, or something like GDP or any other data. But yeah, the international story is a mixed bag. And I do focus mainly on the U.S., but obviously we look at the kind of the major G7, the other G6 countries, as well as some of the more important EM countries. China's obviously still dealing with its kind of long-term overhang of their investment boom, which peaked in 2011. We're now 13 years past that, or 12 years past that. And there's still, people are still talking about a housing bubble bursting and an investment boom bursting. Maybe China becomes looks more like Japan than it does the late 90s EM Asian economies that blew up. And they certainly have the ability to kind of extend and pretend for longer, but obviously the stock market's not buying it. So it's not been a place that we've recommended investors get anywhere near. But I know that was, that was a little part of the beginning of the year story this year and last year. Remember last year, China came out of COVID if I got my years right. In late 2022, everything seems like a blur. So people were bullish on China to start the year. That didn't work out. And then same thing this year, lesser extent, but people had hoped that China was going to do these massive stimulus measures. And I don't think they can, nor do they want to. And I think that's good news for developed economies, because historically those stimulus measures have been very inflationary, and that's the last thing we need right now is, copper, oil, iron ore, surging massively. And Europe, I think, is more similar to the U.S. outlook, though worse. And yeah, we can live in a bubble because that's where the earnings are materially better. Like, are we going to see a big pickup in European earnings anytime soon? Well, they face the same lag of interest rates and high interest rates and weaker pricing power that U.S. companies do, and they don't have the Magnificent Seven or the ability to spend or the appetite to spend fiscally responsibly or irresponsibly as the U.S. has.
So what areas of the market do you see that would perform poorly if we actually see much fewer rate cuts and we see just like maybe 2 or 3 at the end of the year versus like 6 or 7 priced in? What areas of the market are not prepared for that? There was like this hiccup moment last year with like utilities, for example, because there's a lot of like fixed contracts in the higher for longer environment, but I feel like that kind of has passed. What areas do you see risk because of that like viewpoint of much fewer rate cuts?
Yeah. So I think, to first put out like, I guess my base case is I don't think investors are going to worry about rate hikes again anytime soon. So I don't think we'll see the fear that we had seen in 2022. Certainly, let's hope not. Or even so as much as we saw in the late summer, early fall of 2023. We're kind of, as investors and human beings, I think becoming, what's the word?
Complacent?
No, not complacent. It's just, it's on the tip of my tongue, and it's, we're becoming used to it. I can't think of the right word, but we're not as sensitive to it anymore. Because we were shocked by it, we were beaten up by it, and so if we get a higher CPI number or better macro data, I don't think people are going to be quickly pivoting and saying, "Oh my God, maybe the Fed's going to raise rates again." And so the word will come to me, but so there's that, and I think that's with regards to both CPI and the Fed. But if we think about it, I guess the way I would answer that is, well, what went up a lot, especially in November, December, when everyone ran to buy TLT and buy bonds and buy low quality stuff. So we can talk about it from a sector perspective, a factor perspective, and an index perspective. I would say from a factor perspective, companies with the weaker earnings, negative earnings revisions, no profits, highly levered, basically stuff that did poorly in the summer and fall. Because if you don't have earnings growth or an earnings story to support your stock, your PE's got a lot of downside if the macro gets ugly. If the macro looks good, then, we'll see what we saw in November and December with bond yields, rising. But again, why haven't small caps continued to rip? Because bond yields or bonds haven't continued to rip, save for the last day or two. But the earnings story is not there. So that's kind of how I would approach it, as opposed to just saying this sector or that sector, because I always try to think of things from the bottom up and then figure out where we can aggregate those two. So I would say, kind of deep value stocks, high book yield stocks would be kind of a way to think about that. Book yield tends to be kind of a valuation measure that looks more like beta than it does value. I would say, from a sector perspective, banks, the regional banks, because again, why did they rally? To me, the earnings outlook didn't change. It's because their P's went up because duration risks presumably went away. Although clearly in the last couple of days, that's come right back. So I guess that's the way to dissect it. Trying to think what other areas would be at risk there. I guess some of the the cyclical stocks, again, I think you got to pick your spots, because if you get better cyclical data, that could kind of help support the valuation in the market. There's like a sweet spot of Goldilocks, and then there's just like super hot CPI and hot macro news, which I don't think will be welcomed by many stocks at all. So there's kind of gradations in how bad things get. But let's say this year we get 3 rate cuts, not 7. I think the overall market's going to be kind of flattish, and riskier small caps are going to probably be down. And maybe you could shift that parallelly, a little up, a little down. But I think that's the leadership, the way I think about it. Ironically, I think growth would beat value, even if rates back up a little bit, because we saw this last year too. Because in a slowing growth backdrop, quality growth stocks, not all growth stocks, but quality growth stocks, profitable growth stocks, typically still outperform because the earnings backdrop is really weak. The big difference in 2022, why growth stocks got killed, number one, they were at the peak of their valuation hype and COVID hype. And number two, the economy was pretty good in the first half of 2022, or let me say earnings were really good in the first half of 2022. So as bond yields went up, we popped these valuation bubbles in growth stocks, and investors had plenty to choose from, kind of from cyclical old economy parts or pre-COVID economy parts of the market to park their money in. That's not the case today. Earnings growth today is not, on a trailing basis, we're basically, slightly negative. Whereas in 2022, to start the year, trailing earnings were up like 15%.
So I was talking to a portfolio manager today, and I was asking him to explain why there was a period of time where he did so poorly. And his answer was that was a period of time, I'm a deep value investor, where I was doubling up on the deep value when interest rates were at zero and everybody was investing in the hyper growth, low quality stuff. And I get that. Where I get really, where I'm interested in getting your take on something is something that really bothers me deeply. So many companies have big buybacks and they're trading at big multiples. We know the names, right? What's your philosophy around that? Buybacks are wonderful in some respects, but when we go into a recession, whatever we overpaid for as a company looks bad.
Yeah. Ooh, that's a big question. Obviously when you had free money and zero rates, you could argue it made sense to do that. Although Cliff Asness wrote a great paper on, I forgot the title, but it's something like the idiocy of buybacks or something, because, if you're leveraging up your balance sheet, even though you're buying back stock, the risk trade-off at best is a wash, or worse even. But yeah, there's a lot of companies that have a ton of cash and shareholders want it back in some form or another. Companies that buy back stocks tend to be good performing stocks over long periods of time, not because they're necessarily buying back stock, but because they have the cash to buy back stocks. So when you look at like free cash flow yield, a screen of that in companies that are doing buybacks, there tends to be a lot of overlap, and think of those as both kind of under the quality umbrella. Companies that don't make any money aren't exactly buying back stocks, or don't have free cash flow yield aren't exactly buying back stocks. So in a way, a buyback yield is an indirect way to get to quality. I think what's unique today and going forward is that, during COVID, well, maybe not as much during COVID, but, pre-COVID in 2019 and the decade of zero interest rates, you had more and more companies both paying dividends and doing buybacks. And so I remember when that was like really got popular in like 05, 06, 07, and companies would announce a buyback and their stock would shoot up because they were the only ones in town doing it. And then it became something that everyone was doing, or in other words, you almost had to do, again, talking about the bigger companies, to, kind of keep your investors interested and attracted and show signs of strength. Whereas now, I think it'll be more rewarded again, ironically, because it's not as easy to do and not as commonplace because of today's higher interest rates. It's going to weed out companies that can't do buybacks. So, one of the things that, when we look at valuations, a lot of people say, well, look at this stock, it's so expensive. And, we're kind of taught to think, well, valuations is just a reflection of the earnings growth outlook. And I think that's a big part of it. But particularly post-GFC, when the world and equity investors got reintroduced to risk after 20 years of not much of it, I think valuation also kind of comes about by investors, being worried about the balance sheet because they got really screwed by balance sheets in the 08 crisis, or the visibility of earnings, not just the growth, but the visibility of the stability of it. So I think there's a lot of things that go into valuations, and I think buybacks, is kind of a piece of that puzzle. And when we look at stocks valuations and kind of look at them and say, wow, they're so high, and they go higher or they stay high, even if earnings growth are slowing, I think there's other reasons that can explain those valuations. In other words, there's a lot of things that investors are looking for today besides just earnings growth, even though that's clearly something they're still looking for and should look for. But, if kind of macro volatility continues, especially into 2024, in perhaps a weaker earnings backdrop than we had a year ago, the balance sheet's going to matter more. And especially when we look at credit spreads, super low right now, which is consistent with pricing on a soft landing. So when you look at the symmetry of potential outcomes or where spreads are going to go, could they go lower? As long as jobs remain okay, they could stay low. But, a lot of clients this year to date have said to me, the market's not pricing any risk, but there's so many risks, which is consistent with a soft landing. No one's worried about anything until there's something to worry about. And my guess is there's going to be plenty of things to worry about this year, and the market's not pricing any of that in. And so that's, quality, whether it's buybacks, interest coverage, or profitability, I think are all traits you continue to want to own as an equity investor this year, or overweight, I should say.
So I agree with what you just said, but I'm going to challenge something, not necessarily something that you said, but I often hear companies saying we're returning money back to the shareholders through a buyback. Isn't that kind of bullshit? Well, you bought more stock, but the share count didn't come down. Hey, tell me exactly how you return me money.
Yeah,
it's always my answer.
I can't say I disagree with that. I answer this, I'm working a public company and all that. But there's the motivations for buybacks and how those came about. Obviously, if you're if there's equity incentives, that buybacks make sense for as an alternative to dividends. They're not taxed, at least not until you realize any gains. It depends on how you're doing though. But if you're doing buybacks from operating cash flow, that's a very different story than doing leverage buybacks.
Yeah, that's fair.
But again, I would look at it as a symptom of a good company. Again, maybe not a smart company, because like you said, plenty of companies do buybacks at the peak of their stock prices. Not too many companies do the opposite, though some big tech companies did. We all know who that is. But again, I wouldn't short a company if they're doing buybacks or penalize a company. But yeah, I get your point. But here's an interesting fact. When you look at S&P earnings, and not too many investors know this, or just are aware of this. When we look at S&P earnings, so everyone quotes what the forward earnings. Last year earnings were about $220. This year earnings are expected to be about $242. The actual calculation that goes into coming up with S&P earnings does not include buybacks. So let me repeat that. S&P earnings have not gone up 1 cent because of any buybacks. They calculate it. Howard Silverblatt has a paper, you can Google it. And S&P uses net income. It's actually not earnings per share. It's actually net income, a calculation with an index divisor. So again, it's a piece of worthless data for a cocktail conversation. It's not going to change the valuation of the market, but it's an interesting tidbit that not too many people know about with regards to buybacks.
Yeah, that is really interesting. Super interesting fact. Thank you.
So I would say also that in that context, if things go well, interest rates will go down, as you're suggesting, and maybe not as dramatic as people are expecting, but that's okay, right? Markets actually might do something that, nobody's ever really thinking about, which is, we won't go anywhere, right? Sometimes markets just stay flat. They trade in the trading range. And I think what you were saying were like 5 to 10%.
Yeah, well, and a lot of stocks have done exactly that. Literally, if you look at the Russell 2000, we're pretty much flat on the last 12 months. within a 50 bit, within whatever today's volatility was. So, and that's true, to a slightly lesser extent for the equal weighted S&P 500. And so I guess the way I think about it, again, I'm more focused on positioning than the market. Clearly, market call, I had a great market call in 2021 and 22, horrendous call in 23. And, sometimes, I would say as a strategist, that's not where the conviction is. Again, that's what CNBC wants us to talk about. That's what everyone wants to talk about. But there's all the rigorous analysis we do is not on where the S&P is going up or down, but it's what's going to beat, lead, underperform, outperform, and why, and does it make sense? And, because there's a lot more consistency to explaining leadership trends than there is whether the market's going to go up or down, or how high it's going to go up or down. But this is kind of, I guess I'll lay out kind of how I kind of see things. So in November, we had nothing but upside for equities as long as bond yields came down. That was literally a one variable market. I don't think we're still in a one variable market, though. Bond yields clearly are still, have a grip on equities, but to a lesser extent. And when we look at leadership coming off the high in yields, it makes sense that low quality, risky stocks did the best for a number of reasons. They got beat up the most in the summer. I think the Russell 2000 was at a 2.5-year low right before, I don't know, 8 weeks later at a 52-week high. So that'll make sense. I get that. Now, as yields go lower, I think CPI, is going to grind lower. The low-hanging fruit around deflation and disinflation is behind us. I think Powell made a good point yesterday, which is that goods deflation is going to normalize. And we saw that in today's ISM data. We saw the prices paid index, which is like the inflation data for manufacturing, go back into expansion territory or inflation territory for the first time in a few quarters. So that suggests that goods deflation is reinflating, if you will. It's only 1 month, but that's an important data point. So I think from here, bond yields are going to go down at a slower pace. And that's going to be more rewarded by companies that can also continue to put up good numbers or better than their peers' numbers, not low quality, risky, small caps. I think, a lot of the banks, with small regional banks, again, they were a pure bond play in the back half of last year, for better, for worse, or for better. And again, now some fundamental data showed up that has, made investors a little concerned. And you've seen recent days correlation between bond yields and bank stocks have kind of broken down. So, I think you want to kind of, what we're recommending to our clients is stick with companies that are highly profitable, have proven growth, are still seeing earnings revisions, which is still not something that's widely enjoyed by most companies. And even within the Mag 7, we did a report from a strategist take on the Mag 7. And I think Google, Meta fundamentally ranked the best. Obviously, earnings are kind of coming in, and some are better, some are worse. Tesla ranks the worst from our quantitative perspective. Yeah, this is not a buy or sell recommendation, just based on fundamentals that we see. And then, other stuff like Microsoft, Amazon, Apple are kind of more of a mixed bag when we look at those.
Do you guys have any perspective on the IPO market? It's been quite some time since we've had like a flourishing IPO market. And, we talked a little bit about the residential market, but the other side is all these companies that are just waiting in line to one day be public companies. And at some point that either has to occur or some restructuring has to happen in the private market. So how do you guys see that playing out this year? Is there a window where people start getting comfortable and there's like an IPO quarter here, or is there going to be volatility to push that out into maybe even 2025?
Good question. Again, not my wheelhouse, but I work in investment bank, and what I hear from management is if rates coming down, assuming no recession, would be a very welcomed environment for banking activity, and I think that's pretty widely viewed, shared by all investment banks. which, last year, I think, got hurt from the bond yield volatility. So bond volatility's come down. And the question, I think it goes back to how much rates can fall for good reasons or for non-problematic reasons. Because again, rates can come down from here because claims go up to 300,000. Is that a possibility? Yes. Is it happening now? No. CPI can keep coming down. Shelter is going to continue to weigh on that. But I think, if it's going to happen, credit markets are pretty loose right now compared to where they've been the last 2 years. So this is as good as an environment you've seen since 2021. Not to say that we're going back to 2021, but, we're in this window now where the Fed's done and they're talking about rate cuts and, that's incrementally better as long as, bond and financial market volatility stays somewhat muted, which it would most likely, as long as we don't see a real contraction in jobs data. That's been the historical pattern. Every single kind of this soft, hard landing debate, sometimes it ends in recession, sometimes it doesn't, but you get this sweet spot of like Goldilocks euphoria sentiment, which was there in late 06, early 07, was there in the summer of 2000. And you could even see it in 1990 when the Fed stopped in 89. You had a period where the market rallied, credit spreads came down. What popped each one of those was jobless claims rising and the unemployment rate going up. So that's what I would continue to watch. That's the biggest risk to me. But all else equal, no, the path for banking and IPOs should get better. Assume that doesn't happen.
Yeah. So Michael, please tell your bankers, we need more public companies. We need more IPOs. Michael brought up a great point. I'm sorry, David brought up a great point. We really do need more public companies.
That's true. I mean, between the last 20 years of buybacks, which has taken out equity capital, and from Sarbanes-Oxley, a lot of smaller companies not wanting to go public post the early 2000s. That's certainly true. And the private equity money.
Exactly. So really, thank you very much for coming to our show and letting us grill you as we've done. This has been a great discussion. I hope you've enjoyed it. What's the best way for folks to keep up with your work? Is it off of X or Twitter, as they call it?
Yeah, on Twitter, my handle is at Michael Kantrowitz. That's probably the best. Obviously, anyone who is an institutional analyst or portfolio manager, I work at Piper Sandler, and a salesperson would be happy to take your call.
You always got to be plugging, that.
So thanks for having me on. I really appreciate it and enjoy the conversation.
Thank you.
Thank you very much. Thanks, Dave.